Hey everyone, welcome back to the channel, which is all about income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And in today's video, I'm going to review the topic that won the latest survey that I did. Here's the topic, should I sell or swap my split share funds for things like HMAX or other covered call ETFs or leveraged covered call ETFs. A lot of choices, a lot of options and new options for us income investors right now, right? So split share funds, they have that little problem where they're closed-end funds. They have overnight offerings, are a bit more complicated to understand. They could trade at big premiums, and you might miss dividends. So there are now a lot of great options or a lot of great alternatives to these split funds. And in case you missed it, on December 4th, I came out with a video called High Yield Alternatives to Split Funds. Very interesting video. I suggest you check out if you do own any split funds and you're considering this. I actually go over, HMAX is not there because it wasn't out at the time, obviously, but I do go over some high yield ETF or covered call ETF alternatives to split share funds in case you're interested in doing that switch. So I'm going to cover this topic in today's video, and I'll start off by saying you will not get a direct answer. Do-it-yourself investing. There is no right or wrong. What's the best? It's not black and white. You really got to figure out what's best for you, right? So I'm not going to give you a direct answer here, but I will go over 5 factors that I have personally considered and I would personally consider if you're thinking about, or if you're on the fence about if you should get rid of your split funds or swap them into these covered call ETFs. So let's go over these 5 factors together, and hopefully by the end of the video you could do your own analysis and really figure out if it's the best move for you. Let's get started. All right, everyone, let's go over the 5 factors. So should you swap out your LBS for HMAX, your SBC for HMAX, or for bank from Evolve ETFs, or to HFIN, right, which is another leveraged ETF from Hamilton that doesn't use covered call. So 5 factors we should consider. Number 1 is your yield, right? So what is the yield that these split share funds are making for you? If they are obviously above, or they're higher than an HMAX or a bank or whatever it is, you have a little bit more motivation to just hold on and keep your split share funds, right? But if your yield is about the same or lower, well, then you might have a little bit of motivation there to do the swap. So that's factor number 1. Obviously, we're income investors, right? So the yield is your number 1 priority, and there could be a strong possibility that your yield would be higher if you would switch to something especially like HMAX, which is almost 14% yield. But for me personally, I'll give you an example. For my LBS, I'm making just under 17% yield. My SBC 15.5% yield. So I don't really, I would be dropping in yield. But that's factor number 1. Factor number 2 is your book cost. So if you're going to be selling these split share funds at a loss, it's you might as well, it's a factor to consider, that is all I'm saying. If you have a big profit on them, for example, I'll take myself an example here, SBC, LBS, especially SBC, I have a humongous profit on it. Well, if I actually sell it, realize that profit, which would be tax-free, let's say in a TFSA or RRSP account, and then swap it into HMAX, even though HMAX yield is a bit lower than my SBC yield, with all the profit I would realize, my income would go up by about $95 a month if I actually swap my SBC into HMAX. I did the calculation yesterday. So your book cost is very important. If you're going to swap a split share fund and you're making a profit on it as well, that is pretty much a good motivator. But if you're at a loss on it, a big loss, maybe it's not really worth it. Factor number 3 is potential dividend misses, right? So as we know, with ETFs, covered call ETFs, leveraged ETFs, whatever it is, they don't have that caveat or that rule where you could possibly miss dividends, which is pretty much incorporated in the split share fund structure. So in case you didn't know, most 99% of split share funds, if they're unit NAV, so the net asset value of the Class A share and the preferred share together, that's the unit NAV, is under $15, there will be no distribution or no monthly dividend for the Class A shareholder until it goes up. So even things like DFN missed 4 dividends in 2020, LBS missed 8 dividends in 2020. SBC didn't miss any. So of course this varies from split fund to split fund, but you have to take that in consideration. So that is really an advantage that the covered call ETFs have. You're not going to expect to miss any dividends. Am I saying it's impossible for them to miss dividends? I pretty much would say that. It's possible they adjust them, they reduce, but they don't have that. It's not built into the structure where they'll just not pay out the dividend, like a split share fund where it's actually in the prospectus. It's, that's how the fund is built. So the next factor, the fourth factor, is really the fund's composition and the fund strategy. So something like an LBS has very similar holdings to HMAX, for example, but it's not exactly the same. HMAX has 75% in the big six banks. LBS has 60% because it's equally weighted with the other four life insurance companies. Also, HMAX is market cap weighted, so over 40% of the fund is actually Royal Bank of Canada NTD, where LBS is equally weighted. SBC, you pretty much have only the six banks. Yes, there is 10% in that North American Financials ETF, which is mostly US. And BK is the same thing. BK is not, if you actually look at the holdings on Quadravest website, it's 90% the six banks, or more than 90%, but there's also other stuff as well in BK. So you got to look at the fund composition. What do you really want, or what are the companies you prefer? HMAXs could be very interesting because there's that Brookfield, there's 10% in Brookfield. So it's really personal preference when it comes to the holdings and composition. Remember, the more diversification you have, the better off you'll be. Long terms. It's a safety thing. But on top of the fund's composition, there's also the fund's strategy, right? So a split share fund has leverage, but it's synthetic leverage. And a good advantage of that, not many people think about this, is that when interest rates rise, classic leverage gets more expensive. So, the leverage that HDIF or HDIV, HYLD takes becomes a little bit more expensive as interest rates rise, but the split share fund leverage stays the same because it's synthetic leverage. You're not borrowing money. It's leverage built into the fund. So there's that factor. The covered call strategy as well, right? So something like an SBC LBS, it's, Brompton, they do less aggressive covered calls. They're typically out of the money covered calls. Sometimes they don't even write covered calls at all if they feel that the portfolio is going to grow. So, you have a combination of leverage, synthetic leverage that is, and modest covered call writing, where HMAX is going to be really more aggressive covered call writing. So you're getting nice premiums, high yield, you're giving up more upside potentially, and there's no leverage. So if there's no leverage, the covered calls have to be a lot more aggressive, and that's what HMAX does, which is fine. I'm not saying it's a bad thing. It's called HYLD, HMAX. It's called yield maximizer. It's in the name. So the primary focus is yield, but maybe you want a little bit, you prefer an LBS or an SBC because maybe there's more growth potential. I'm not sure. That's something we'll have to wait and see how HMAX kind of behaves. But these are all factors you need to consider: the fund composition, the fund strategy. There's management fees as well. There's total return history. Of course, if a fund's new, you're not going to get that. But with the split share funds that have been around a long time, their total returns are really, really good. Like LBS and SBC, even BK, if you go, you can check that out. So these are all factors you need to consider as well. Factor number 4. Last but not least, factor number 5 is your personal preference, your personality, right? If you just will sleep better knowing that you're swapping out some or most of your split share funds, or even a portion of them, for the leverage covered call ETFs or covered call ETFs like HMAX, whatever it is. Now we have, for the banks, or the Canadian financials, we now have HMAX, we have bank from Evolve, we have HCAL and HFIN, which are both leverage but don't have covered calls. So there's amazing great options. And again, check out the video I produced or I published on December 4th to learn about these options. But you gotta remember that do-it-yourself investing is really subjective. Whatever makes you feel better. If you feel it in your gut that it's a good idea to switch them or switch a portion of them, go ahead and do that. Just remember, to consider all the factors and make the decision for yourself. Don't worry too much about what other people are doing. I see that all the time on, the YouTube comments, on the Facebook group, and it's great. People are talking to each other. They're kind of hashing it out. But in the end, everyone, this is do-it-yourself investing. You got to make the decision for yourself. So there's no need to panic or to freeze. Just do the analysis, look at these 4 factors, plus of course this one, your personality, and then you could make try to make the best decision for yourself. So that's it, everyone. Hopefully these factors will help you make a decision. If you're wondering, what am I gonna do? Well, keep watching my monthly portfolio unveil videos. I show what all my moves from A to Z every single month. So you will see what I personally do. But considering, just to give you a little teaser here, considering the yield I have on SBC and LBS, I will probably keep them, but I will definitely invest in HMAX as well. So here's another thing to consider, guys. You could take a hybrid approach, right? It's like I said, it's not black and white. You don't have to just get rid of all your split share funds and swap them into things like HMAX. You could do half of it. You could take a hybrid approach and maybe swap out half of them. You could another option would be just to leave your split funds how they are, just keep them, and then going forward, if you want to invest more in Canadian financials, for example, go with the HMAX. So you could also be diversified across managers and strategies. There's nothing wrong with that, and I would actually encourage you to do that, because it's a good idea to have multiple managers, multiple strategies, and after a year, 2 years, 5 years, you could maybe compare. Once we have more data on HMAX, you'll see how it behaves after a year, after 2 years, because right now it just came out, for example. So you'll be able to make a better informed decision. So there's nothing wrong with having multiple funds, even if they have the same, most of the same holdings, because having, diversification of strategies, covered calls, aggressive covered calls, less aggressive covered calls, a bit of leverage, a lot of leverage, no leverage. It's not really a bad idea. It's not a wrong thing just because you have more holdings, right? So I see this a lot, and this is something I don't agree with. If you have 20, 25 holdings, it's a bad thing. You should only have like 10 or something like that. Why? It's not necessary. You do you, and I'll do me. That didn't sound right, but you know what I mean. We each have to make the decision for ourselves. So you could also take a hybrid approach, everyone, just throwing it out there as an option. So let me know what you're gonna decide in the comments below. Hopefully these 5 factors and this video will help you make the decision. Hey, don't go yet. I have some important reminders, including some more recent ones, and I'll try to keep it as brief as possible. And for everything that I'm about to discuss, the links and info are in the video description below. So first of all, if you didn't know yet, I do offer a one-on-one coaching session where you'll have a 1-hour Zoom call with me where you could ask me all the questions you want, and I'll help you and assist you best I can. Just remember that I am not a licensed or registered financial advisor or planner. So to book a session, go on my website, passiveincomeinvesting.ca, and right there on the homepage on the left hand side there is a small video. Watch that video to know how to book a one-on-one properly with yours truly. Also on my website you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once, and this is really a reference tool or a companion tool to help you build your own portfolio according to your needs and your objectives. It has lists of funds, it has sample portfolios for both Canadian investors and American investors, so make sure to check it out on my website. I actually created a video which shows the product from A to Z, because I don't want you to spend money unless you know exactly what you're getting. So make sure to check that video out on my website, and don't take my word for how good it is. Check out the reviews. There's over 300 of them, and they are all 100% real reviews. So here's some more updated news or recent news. I am now on Blossom, a new investing app designed for investors. I've been using it for a few weeks now. I think it's really, really great. It has a really cool feature where users could actually add and share their portfolios and what they're buying and selling every day. So you could actually link your investing account so it's updated automatically on a daily basis. I recently added my own main portfolio, so you could follow how my portfolio is doing live and what I buy every month. Really, really cool. It's like a mix of Facebook and Twitter, but specifically for investing. So get on your phone, click on the link in the video description below and download the app. It's 100% free, so you too could share your portfolio. Just remember to look for me and follow me. My username is Adrian, PII altogether. Also, I do have a referral link for Questrade, so you could get $50 worth of free stock purchases. This is the Canadian discount broker that I use and I recommend. Unlike Wealthsimple, the other popular discount broker in Canada. You could drip everything you want. It has all the stocks, and it also has dual currency accounts. Very, very convenient if you're buying both Canadian stocks and American stocks. I have a Questrade video, by the way, which gives you a little tour of the features, so make sure to check that out. I also have a referral link for PASSIV. This is the portfolio tracking tool that I use to consolidate all our accounts to get a nice bird's eye view, so you can consolidate all the information together for easy tracking and stats as well. Also, our Facebook group, Passive Income Investing, is now an invite-only private group. So to join it, you need to click on the link in the video description below and give the group a like to get invited. So we take pride in making this one of the best investing Facebook groups out there, with over 13,000 members. There's no scams, there's no spammers, and negative and doomsday people, we kick them out right away. Also, follow us on Instagram if you want a little bit more of our personal journey here in Panama. And lastly, just remember, everyone, I am not a licensed or registered financial advisor. This channel is all about my personal investing journey and how I invest to generate high passive income from a diversified portfolio of high yield funds. It's for educational purposes only, so don't forget to do your own research and due diligence. And of course, stay safe, everyone, stay healthy, and of course, stay passive. See you next time.